Is the DAX in Germany. Back on Wall Street, the U.S. market is trying to bounce back this morning. Take a look at where we stand with money moving into equities. We are still looking at a decline of 12.5% from the high, so we are certainly in correction mode. The Dow closed down better than 400 points yesterday. Joining us right now is Cantor Fitzgerald, CEO Shawn Matthews. Shawn, good to see you. Thank you so much for joining us. I want to start off by asking you really what you're seeing in terms of your clients right now. You know the activity on the desk. You're seeing the money move. What are you hearing from clients these days? Well, it's interesting right now because in the fixed income market, the clients are just sitting and watching because the marketplace is really not moving. There's not a lot of volatility and there's not a lot of volume. The equity market drastically different, right? So you have people who are trying to hedge out their positions in some cases, people looking to try and call bottom. So it's really now about people being opportunistic in the equity space and really complacent in the fixed income space. So they're not. Are they very nervous about the stock market decline that we've seen in this correction?
Absolutely. And you're starting to see people hedge.
And are they raising cash?
People are either raising cash or hedging. So if you think about it over a several-year period, people weren't hedging as much as they normally do because everyone was complacent. The market was going up. It had a great feel to it, zero interest rate environment. So you had less hedgers. Now you're starting to see people come into the marketplace and actually hedge.
And usually that's manifested through volatility, as you know. So we've had this big phase transition of basically 12 to 15 VIX to 30 plus.
Correct.
You know, isn't that good for your business? Volumes by my scorecard have been huge.
Yes, volumes are great, so people are trading more, and we're getting closer to a business cycle mentality.
Okay.
When interest rates start going up, people start to think about business cycles, and that's good because people trade business cycles.
But will they go up this year? Right.
Will interest rates go up this year? I think they will. I think they will. I think the Fed clearly wants to raise interest rates. Part of it is to protect the banking system. So in effect, deposits, and if people are putting money in a bank, the bank is losing money on that money, right? Yep. So they're actually giving money back, which is unique, right? Because you think banks hold cash and hold money. So the Fed is trying to protect the banking system. I think first and foremost, that's why they'll try to raise rates.
How much of the volatility do you think is born out of that just the rate call just being wrong? Like if you look at Bloomberg consensus estimate for the 10-year, it's at 3.15%. We're 100 basis points below that. And if bond yields reflect the rate of change or growth slowing in the economy, aren't a lot of people caught off sides on that trade?
Well, I've been in the business 25 years. The forward curve's been wrong for 24 years, probably, right? And so the forward curve always has that implication that rates are going up, except in extreme cases. So I don't think it's that. I think people are just trying to understand where the flow of funds are going. Okay. And really, we've been in a market where people felt comfortable with zero interest rates. If people felt comfortable there's going to be no external shocks. So you put your money in equities and you try to be as tax efficient as possible and hold on for as long as possible without hedging. That's changed now.
You talked about fixed income and no volatility in fixed income, but you did see a sell-off in high yield. How much of that was just energy? Did you see weakness in other sectors of high yield, and is that still worrisome?
Energy clearly has been a volatile sector, and high yield, which really had a tremendous amount of covenant-light paper in that space, really caused all the commodity issues. Right? So if you think about the commodity prices, it was driven by cheap capital coming in from the high yield sector, which allowed people to go out and then put more money into their business. That's changed. You really haven't seen a massive amount of contagion flowing out of that space. You're still seeing some deals getting done. It's been a move, but it hasn't been a significant move outside of energy.
Shawn, it sounds like you're relatively optimistic on U.S. stocks. It's a broad generalization, but it sounds like you think that things are eventually going to turn around, be okay, go higher from here.
I think if you're putting money to work today, I think, and you look back 2 years from now, you're okay.
That's what I'm saying. So you started out by saying that this is a good time to look for opportunities. I mean, you guys are employed to do that. Where do you see opportunity right now?
Look, I think the energy space is pretty interesting. So, again, if you think about how commodity prices got to where they got to, it was caused by the cheap money. That cheap money is now being sucked out of the sector. So inevitably, you'll have contraction in the space, which has already started to happen. You'll have prices come down, which has already clearly happened. And the stocks that are standing will reflect significant value because they'll be able to buy assets relatively cheaply that was caused by the cheap money that caused the commodities to go up in the first place.
But it's also caused by the weakness in China, right? I mean, China was among the big buyers of commodities, oil included, and that economy is slowing down. That story hasn't changed.
And that won't change, right? So
you still want to buy energy even though that story hasn't changed?
Because I don't think people really believe the 7, 8, 9% that China was saying anyway for the last couple of years.
True.
Now, it's slowed down from there further.
Yeah.
But remember, China has a tremendous amount of currency reserves, which will allow them to work their way through their problems. And I think they will figure it out. So, again, it's not going to happen today. It's not going to happen next month. But certainly if you look back a year or two from now, things will look drastically better in the energy space.
Yeah, on energy, it's like it's an old adage. But again, an investor is a trader who's underwater. So you'll hear a lot of investors say, okay, now, or a lot of traders, like you just said, if you go out 2 years now, I mean, usually I think you're thinking, or at least where I grew up, we're thinking 2 days, maybe 2 weeks. What about volatility? You got OVX, like oil volatility, 55, 60 type level. Is that something that you look at as a concern or something that you see as a buy signal?
I think it's probably a buy signal in some cases, but look, the moves have been crazy the last 2 weeks, right? So you can't explain down and up, right? So it's really money moving in, it's speculators trying to figure out what's going on. So you have to take a somewhat longer term trend and thought process to this marketplace to rationalize where you stand.
Even if you're looking at the long term, are there places that you can identify as places to hide in this sell-off?
Look, I think the high yield market in general is a place where inevitably in a business cycle, and again, if we get back to a business cycle thought process, high yield becomes equity at some point in the cycle. And that would be a concern of mine, especially in some places where you still have relatively high leverage at low yields.
All right, we will leave it there. Shawn, great to have your insights today.
Pleasure.
Thank you so much. Shawn Matthews, the CEO at Cantor Fitzgerald. Taking another